Most investors chase dividend yield. They'll scroll through lists looking for the highest percentage, grab whatever pays 4 or 5%, and wonder 6 months later why the stock collapsed and the dividend got slashed. But here's what Buffett would tell you, and it took him decades to fully articulate this: yield is almost irrelevant. It's a symptom, not a cause. The real question is whether a business can keep paying you for the next 30 years without skipping a beat. Warren Buffett has reportedly generated somewhere around 60% annual yield on cost from Coca-Cola. Based on publicly available filings, Berkshire collects over $800 million per year in dividends from a position that cost approximately $1.3 billion total. That's not luck. That's not finding a high-yielding stock at the right time. That's applying a specific filter to identify businesses worth holding forever, and then actually holding them. Quick disclaimer: I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Today, I'm walking through the exact criteria Buffett uses before committing to a forever holding. Not the theoretical stuff you'd read in a textbook. The actual filters he's applied across 6 decades of outperforming the market by double digits annually. And by the end, you'll have a framework you can use to evaluate any dividend stock before you commit your capital. Here's what most people get wrong about Buffett's approach. They think he's a dividend investor. He's not. Berkshire Hathaway doesn't even pay a dividend. What Buffett actually does is find exceptional businesses that happen to generate so much excess cash they can't help but return it to shareholders. The dividend is a byproduct of quality, not the reason for buying. In his 1987 shareholder letter, Buffett laid out something that should have changed how every investor thinks about dividend growth. He said a good investment must meet 2 conditions. First, average return on equity over the past 10 years should exceed 20%. Second, no single year during that decade should fall below 15%. Not a small dip, not one tough quarter that averaged out. Every single year above 15%. Think about how few companies can clear that bar. When researchers actually ran the numbers on the Fortune 1000, only 25 companies qualified. And historically, 24 of those 25 outperformed the S&P 500 during the following decade. That's not a guarantee. Past performance never predicts future results. But it's a filter worth paying attention to. But return on equity is just the first checkpoint. Let me show you what comes next. Buffett talks constantly about economic moats, the durable competitive advantages that protect a company's profits from competitors. But he's specific about what actually constitutes a moat. It's not just being good at something. It's being good at something in a way that competitors cannot replicate without destroying their own business model. Harry discovered this the hard way. He found a company with a 22% return on equity, solid dividend history, reasonable payout ratio. Everything looked perfect on paper. What he missed was that the company's advantage came entirely from a single patent that was expiring in 18 months. 2 years later, generic competitors had slashed margins by 40%, the dividend was cut, and Harry was sitting on a 35% loss. Buffett identifies 4 types of moats that actually last. Brand power, like Coca-Cola, where people will pay more for an identical product just because of the name on the can. Network effects, like Visa and MasterCard, where the payment system becomes more valuable as more merchants and cardholders join. Cost advantages, like GEICO, which sells insurance directly and operates at lower costs than competitors who pay sales commissions. And switching costs, like Apple, where leaving the ecosystem means losing your apps, your photos, your music, everything you've built. The question isn't whether a company has an advantage today. The question is whether that advantage will still exist in 20 years. Now here's where Buffett's filter gets really specific. He doesn't just want profitability, he wants predictable profitability. In his shareholder letters, he's emphasized that he needs to be able to reasonably estimate a company's earnings for at least 5 years into the future. If the business is too complex, too cyclical, or too dependent on technological shifts, he walks away, regardless of how attractive the current yield might be. This explains why Buffett avoided technology stocks for so long. Not because he didn't understand the products, because he couldn't predict which companies would still be dominant in a decade. The tech landscape changed too quickly. Winners became losers overnight. That uncertainty violates his most fundamental principle. You can't hold forever what you can't predict. But this also explains his eventual investment in Apple. He didn't view Apple as a technology company. He viewed it as a consumer brand with locked-in customers, exceptional returns on capital, and predictable cash generation. The moat wasn't the iPhone's technical specifications. The moat was the ecosystem that made switching painful. Let's talk about debt, because this is where a lot of dividend investors get burned. Buffett has a clear preference for companies that fund their growth through earnings rather than borrowing. He wants to see a debt-to-equity ratio below 0.5. He wants interest coverage ratios that show the company can easily service its obligations even if earnings drop temporarily. And most importantly, he wants consistent free cash flow, the actual money available after running the business and maintaining equipment. Here's why this matters for dividend investing. A company can maintain a dividend for years while slowly deteriorating if it's borrowing to cover the gap. The income statement looks fine. The yield stays attractive. But the balance sheet is screaming danger to anyone who bothers to look. When the music stops, when credit markets tighten or rates spike, these companies slash their dividends overnight. The investors chasing yield get destroyed. Chevron is actually a perfect case study of what Buffett looks for. It's an oil company, which means profits swing wildly based on commodity prices. That should disqualify it, right? Except Chevron has increased its dividend for 38 consecutive years. Through oil crashes, recessions, and global pandemics. The company structures itself to maintain the dividend regardless of where oil prices go. That's not luck. That's intentional capital allocation designed to protect shareholders. Buffett's position in Chevron yielded about 4.5% when he built it. Not the highest in the sector, but sustainable, protected, likely to grow. Now let me share something counterintuitive about how Buffett thinks about payout ratios. Most dividend investors want high payouts. If a company earns $10 and pays $8 as dividends, that 80% payout feels generous. Buffett sees it differently. He actually prefers companies that retain a significant portion of earnings, as long as they can reinvest those retained earnings at high rates of return. Think about the math. American Express has a payout ratio around 20%. That sounds stingy compared to a utility paying 70%. But American Express reinvests that retained 80% at returns, exceeding 20% on equity, which means the earnings base, and therefore the future dividend, grows dramatically faster than a company paying out most of its profits. Harry ran the numbers after watching his utility stocks go nowhere for a decade. A company growing dividends at 10% annually will double your income in about 7 years. A company growing at 3% takes 24 years for the same result. The starting yield matters far less than the growth rate when you're measuring in decades. This is why Buffett's cost-basis yields have become so extraordinary. He bought Coca-Cola in the late 80s. The initial dividend wasn't spectacular, but 63 consecutive annual increases later, he's earning nearly 60% annually on his original investment. That's the power of compound interest working through growing dividends over time. Let me pull this together with Buffett's ultimate test. In multiple shareholder letters, he's described asking a single question about every potential investment. Will this business still exist in 20 years? And will it still be profitable? If there's any doubt, any reasonable scenario where technology disrupts the model, or competition erodes margins, or consumer preferences shift fundamentally, he passes. This is why Berkshire's investment portfolio looks almost boring. Coca-Cola has sold the same basic product for over a century. American Express has dominated premium payments for decades. Kraft Heinz owns brands that sit in every grocery store in America. These aren't exciting companies, they're predictable companies. And predictable is precisely what you want when your holding period is forever. Buffett crystallized this perfectly in his 2024 shareholder letter. He wrote that when you find a truly wonderful business, you stick with it. Patience pays. One wonderful business can offset the many mediocre decisions that are inevitable. He's essentially saying that most of your stock picks won't work out perfectly. And that's fine, as long as a few exceptional holdings carry the portfolio. So how do you actually apply this filter? Start with return on equity. Pull the 10-year history. If there's any year below 15%, or if the average falls short of 20%, move on. There are thousands of stocks. You can afford to be selective. Check the moat. Can you identify a specific, durable competitive advantage? Not good management or quality products. Actual structural advantages that competitors cannot easily replicate. Brand power, network effects, cost advantages, switching costs, regulatory barriers. If you can't name the moat, there probably isn't one. Examine the balance sheet. Low debt to equity. Strong interest coverage. Consistent positive free cash flow. These aren't optional. They're the foundation that lets a company maintain dividends through recessions. Look at the payout ratio in context. A high payout from a declining business is a warning sign. A moderate payout from a company reinvesting at high returns is exactly what you want. And finally, can you imagine this company thriving in 20 years? Not just surviving, thriving. If the answer isn't a clear yes, keep looking. Buffett hasn't bought a single share of Coca-Cola since 1994. He hasn't sold one either. That's not laziness. That's the result of applying these filters correctly from the beginning. When you buy right, holding forever isn't discipline, it's just common sense. The investments that truly build long-term wealth aren't the ones that excite you. They're the ones that bore everyone else into overlooking them. While other investors chase momentum and trends, the quiet compounders keep paying dividends, keep growing earnings, keep widening their moats. In his 1988 letter, Buffett explained exactly why he'd hold Coca-Cola forever. He wrote that when you own portions of outstanding businesses with outstanding managements, your favorite holding period is forever. You're not watching the stock price. You're not timing entries and exits. You're collecting a growing stream of payments from a business that gets stronger every year. That's not a strategy. That's a philosophy. And after 60 years of outperforming the market, maybe it's worth considering whether Buffett might be onto something.